You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to Wealth Formula Podcast. And of course, today is Wednesday, and the show that we do every Wednesday, except for when Zulfe has plans with his children, like dropping them off somewhere or another. Zulfe of Valeri Group. Zulfe Ellie, how are you?
Hey, Buck. Good to see you again.
Good. We were both wrong last week. We were both wrong.
Well, I'd like to think that I was right until you swerved me into your direction.
Yeah.
But
Both of us called 25 basis points, but we're talking about the rate cuts by the Federal Reserve, of course, and Zulfe and I both predicted 25 basis point cuts because we thought the Fed was going to be more conservative. But as it turns out, the Fed seems to know something and is not willing to wait. Is that fair?
could be that that's the explanation. I think not just us two, but there's a fair amount of smart people expecting a 25 basis points cut last week, but there was also a fair amount of smart people thinking 50. So yeah, at the end of the day, I don't think it's a right or wrong answer. It's with the direction that, the Fed decided they wanted to head to. Why would they cut by 50 basis points? Chairman Powell had some very specific comments. In fact, he even said that had they had the July unemployment data that came out just after the FOMC met during the last meeting in July, had they had that before their meeting, chances are they would have cut 25 basis points at that point. And so you could view the 50 basis cut that happened last week as kind of a 25 attributable to the July, meeting and 25 for the September meeting. So it's kind of all, very gradual as they like to do it. He also pushed back because I think, very similar to the speculation that you just made, which is does the Fed know something? I.e., are there some economic danger signals that the Fed has that they're not outwardly talking about? And he got that type of questioning in his Q&A session, but he held very, very strong. He's like, no, just reiterating, economy is solid, and instead the way to view it is a preemptive action. What we want to do is we want to avoid getting behind the curve so that, all of a sudden the economy is sputtering, the labor markets are weakening too much, and then we're racing to try to catch up.
Kind of like what they did on the other side, right?
Kind of like what they did on the other side. So I think they're being a bit more proactive or forward-looking than they did on the way up. Again, it all depends on how things play out, but I think that's the rationale at this point. The Fed also outlined that they expect to do 2 more 25 basis points rate cuts for the rest of 2024. So that's another 50 basis points, which along with the last week's, would reduce by 100 from where we were previously at 5.25, ending the year 4.25 would be the target at this point. And then beyond that, they think another 100 basis points in 2025 so that, you end up closer to somewhere around 3.25 at the end of that year.
Well, so that raises a question that came up in our sort of insider group that I think I forwarded to you, which the question is, well, why? I mean, why are they projecting out so far? What's behind that?
Yeah, so ultimately what the Fed is going to try to drive the interest rates to is what's really called or referred to as a neutral rate. A neutral rate is a theoretical rate. It's not something you can observe or precisely calculate. But basically what the neutral rate means is that is the point of a level of interest rate that supports a full employment in the economy while keeping inflation constant, right? So you got full employment, no inflation. That's what their target is. if you look at what's going on in the backdrop today, what's going on? You have decreasing inflation, which is good because we still want the inflation to go down to about 2% instead of kind of the 2.5 that we just saw in the last CPI that came out. And we're also getting a weakening job market that was pretty consistently weakening for, I think, 4 of the last 5 months now. And then there was subsequent revisions to that to show that actually the job market was weaker than the Fed had thought. So, the idea here is that the market is on a trajectory of labor markets becoming much weaker. Inflation is likely to, head down to where the Fed wants it. So they got to start putting on the brakes. A 50 basis points cut doesn't do the job. It only starts us on that journey. And so the Fed has to keep gradually decreasing rates with the goal of getting to kind of this neutral rate, this theoretical neutral rate where inflation is stagnant, there's no inflation, and then employment remains healthy. So we've got a nice, healthy market. So that's kind of the way to think about it. It's a journey rather than a one step kind of move. The 50 basis points, if they were to stop today, it is still what would be considered a restrictive environment from a rates perspective. That means businesses are still slowing down. They're not going to be out there spending that much more when a Fed rate is at 4.75. The housing market isn't going to be that much improved. Labor markets aren't going to be, steadying, that sort of thing. So
I guess the important thing for us, at the end of the day, the reasoning I suspect is somewhere in some very complicated macroeconomic math, but that actually projects out what's needed to get to this neutral point, right? But I think the net story for us that's really important is that there is this, a stated decrease in rates from now to the end of next year, which is basically 1.5%, right? I mean that's kind of what we're looking at compared to today, right?
Yeah.
So
that's right.
Yeah,
that's right. I mean, there's risk to that, right? So if all of a sudden, and it's going to be an extremely data dependent kind of, activity going forward here. If all of a sudden we see inflation, kicking back in, or, the labor market starting to tighten again, and companies can't hire and all that, then I think, the Feds could put a brake on this rate cutting cycle. And revisit the whole premise. But I think, again, with the fact that the Fed was willing to go out with what's a relatively aggressive rate cut, I think that their data and their expectations are clearly that that's not the likely scenario. The likely scenario is that, if anything, the likely scenario or the risk that they're seeing is that the jobless situation becomes all of a sudden really bad, and then you create this vicious cycle where the labor markets crack, consumer sentiment goes way down, consumer spending goes way down, which then causes further weakening of the job market, and you get into these kind of circles that feed on themselves. So I think it was a really good move to make it a 50 basis points cut. Signal that out to the market, signal it out to companies that want to start making some capital investments, to investors who want to deploy capital. It's the right thing to do to steady the economy before it goes into a tailspin.
So how do the markets react?
Well, as you would expect, the stock market has rallied pretty much all week. So we're S&P, Dow Industrials, both at all-time highs. Nasdaq has rallied, but it's still a few percentage points below its all-time highs. Again, that's more of a factor of the fact that Nasdaq consists of some of these very large mega cap tech stocks which have traded off, and there's a lot of rotation going on to other names, which again is very healthy. because investors feel that there's a broader base of companies that are going to continue to do well here instead of just relying on a very small segment of the corporate base. On the debt side, on the treasury side, 10-year yields are relatively similar to a week ago, maybe ticking slightly up. So I think
Yeah,
last time
I
we
was
spoke-
actually surprised by that, though. Why?
Yeah.
I mean, why do you think so? When we talk about the 10-year Treasury, the way I think about it, and tell me if I'm wrong, but that's the way the markets kind of anticipate the positioning of long-term interest rates, like the Fed's
Yeah.
what the Fed's going to do in the future. That's kind of what they're kind of doing, right? That's kind of what I think of is the market reacting to for the 10-year Treasury. First of all, is that fair?
Yes, correct.
Yeah.
Correct. The market decides the yields on those treasuries because
So
they're
then-
publicly traded.
So then, why, with this aggressive cut and an announcement of another 150 basis points over the next
Yeah.
year
So
and a quarter?
with the cuts, what you're going to see is that the short end of the curve, the 2 years all the way up to the 5 years, they're going to kind of build in some of those cuts themselves as the rates come down, particularly on the very, very short end, right? So if you look at stuff that yields within a year, that's going to be very directly impacted.
Right.
What happens on the longer end is actually a little bit of the opposite, which is because the market believes that we are now headed into a situation of lower rates in the near term. The markets, when they look 10 years out, start pricing in higher inflation many years out, right? So if you're in a situation today where the rates are very restrictive, if they're really high and they're not coming down, then you get a flattened yield curve because markets are not seeing when that inflation will actually kick back up in the future at some point. But when you start going into a short-term low interest rate environment where corporate activity is going to pick up, consumer activity is going to pick up, labor markets are going to be strong, all of a sudden the markets believe that in a longer term perspective, i.e. the 10-year, rates are going to start going back up at some point. And so you're going to get higher yields on the 10-year. And what's happening is you go from what is an unnatural inverted yield curve to the point where now it's not inverted anymore. So you're going to start seeing the longer end of the curve priced higher than the lower end of the curve.
What about SOFR? Because SOFR is supposed to sort of react to,
And it
Fed
has.
It-
Yeah, it has. It has. If you look at where it was before the day before the Fed cut, it was at 5.3%. Right now it's at 4.8%. So it's exactly 50 basis points down. So
okay, wow, that's actually pretty nice.
it's a like for like. So every time this rate Fed rates go down, you're going to expect pretty much a like for like decrease in SOFR.
So I mean, and this is really important just from the standpoint of, a lot of people are in real estate right now that was it's on floating rates, that maybe it was not Freddie Fannie stuff or whatever, and they're waiting to refi apartment operators and such. This is SOFR drifts lower. What's happening is if people can hold on a little bit longer, they can refi into Freddie Fannie long-term debt. And what that does is, and we've talked about this, it basically significantly de-distresses the market. In other words, right now, if there are apartment operators that have floating rates that are making things really, really tight, if rates continue to go down, you can potentially lock in to a fixed rate debt that kind of just creates stability. And so I think you're going to see that because SOFR's got to go down. We know SOFR is going to follow the Fed rate, right?
Yep.
And that's what these Freddie Fannie loans use as SOFR. So, that just again to reiterate again, it's a unique time to be buying because now what you're doing is there are some sellers who need to sell because they don't have a year to hold on. I mean, their mortgage is ending tomorrow, right? And you got to get out quick. And so there is that distress that makes this sort of that Goldilocks period of buying. And we've emphasized that a bunch of times, but again, it's worth mentioning.
Some of the other asset classes that we usually just take a price check on. Gold is just a star performer this year. So it actually is up 4.5% from last week. So it's now, latest I checked was $2,680 per ounce, which is just phenomenal. It's up 30% year to date, which is extraordinary if you think about it. So that has been a unique performance for gold. You haven't seen that kind of run up in the asset class. I don't know since when.
Yeah.
So.
Yeah.
Yeah. And Bitcoin seems to be hanging in there.
Yep.
It's roughly unchanged from last week. It's traded a little lower, traded a little higher, but seems to be roughly about the same price as we had last week.
My house is on sale, and I had a 22-year-old kid who's got apparently 300 million plus in Bitcoin asking if I'd take Bitcoin. Isn't that crazy? Freaking crazy.
Oh man, that is crazy.
Yeah.
You should. Why wouldn't you take?
I would have to. I have to factor in the volatility a little bit because, within a week, you could be down 10% or 20%, and sometimes you get caught up in conversions and transactions and stuff, and so So I didn't say.
There's got to be. I wonder if there is a kind of an accepted premium that when people try to buy assets.
Yeah.
And I'm not talking about like just small dollar assets, but like the price of maybe a car, a home, that sort of thing. If there's an accepted premium that if somebody's paying with Bitcoin just because of volatility,
I would think at least 10%.
Yeah, I was going to say 20.
Yeah, that's what I suggested. Yeah. But anyway, he hasn't come back to me yet, so we'll see. Because I think 20 is probably safe when we're talking about those kinds of numbers. So, but anyway, yeah. So. Too bad we didn't buy a lot of Bitcoin in 2012 or 10,000 Bitcoin for a pizza back in the day, or 20,000 Bitcoin, whatever it was, the first transaction.
I wonder if that pizza company owner has that, or if he's No, I don't think he does. And there was like some documentary on this something. And the guy who actually sent, and I think it was like 20,000 Bitcoin actually, which, I mean, what does that come out to? I hope he got the Supreme for that.
Yeah, I mean, he got the Meat Lovers pizza for that, for sure. But the guy who sent it, apparently, he just said he has no regrets. And, well, good for him. I would.
I'd be kicking myself.
Yeah. Okay, well, yeah, I think that's, I know we usually have a product and all that, but I think that's a good place for us to stop. I know you've got a tight schedule. People may or may not know there's an offering right now in our investment club through Valerity and Zulfe. So if you are not part of the investor club and you are an accredited investor, make sure you go to wealthformula.com. Sign up, get onboarded, and when you do that, you can potentially be involved with some of the stuff, because we're talking about the very distressed assets that we think are going to be on the endangered list within the next year or two. So check it out. Go to wealthformula.com, and if you want to hear more from Zulfe and how Valerity Wealth can help you, of course, go to valeritywealth.com. That's VELERITY wealth.com. All right, Zulfe, thanks so much, and we'll catch up next week.
Thank you, Buck.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.